Okay, so this is part one of the review for exam number 3. This is budgeting problems. And I'm going to start off with a few multiple choice here. Which of the following is true as a budget? Um, Budgets are used to express only the operational, not the strategic plans. That's not true. Budgets do not account for financial aspects of the upcoming period. Um, That's not true. Budgets are most useful when they are planned independent of companies. Um, budgets, no, B, budgets do not account for non financial aspects. Do not. No, that's not true. Budgets help managers revise their plans and strategies. Yes, that is true. So D on that one. Number 8, participation of employees in the budgeting process helps create better commitment towards the budget. The operating budget process generally concludes with the preparation of, and there's only two possible answers here: production budget or the cash flow statement. It's going to be the cash flow statement, right? Um, these two are definitely financial budgets, they're not operating budgets. The cash flow statement, in my mind, kind of straddles the operating because we do our cash collections, our cash disbursements, and then comes the cash flow statement. Then number 14, which of the following are true of master budgets? Uh, they include only financial aspects and exclude non-financial. That's not true. Include both financial and non-financial. That's a good possibility. They aid in quantifying the expectations of all stakeholders. No, it's just the management. And they must be administered rigidly if committed to now. So B is the correct answer there. Then we get into some variance issues. Variance is the difference um, between the actual fixed cost per unit and the standard variable cost per unit. No. The standard units of inputs and one output. No. The difference between actual result and budgeted performance. Um, um, Actual results and budgeted performance. That's probably the best answer. A flexible budget contains budgeted amounts for actual output. That is true. Not the static budget amounts. Actual costs for action. No, actual no. So A is the best answer of that one. And then finally, 17. An efficiency variance represents the difference between the actual input quantities used last period and current period. No. An actual input quantity and a budgeted input quantity. So that would be the correct answer. Let's see if we've got a D over there. Yeah, and it's main competitor, so that's not going to work. Okay, number 18 here. The process by which a company's products and services are measured relative to the best possible levels of performance in competing companies is known as benchmarking. An unfavorable variance indicates that actual costs are less. No. Actual revenues exceed. No. Actual units sold are less than budgeted units. That could be true. And budgeted contribution margin is less than the actual amount. So no. So only C makes sense on that one. Number 20, a disadvantage of a static budget is it's based on only one level of activity. That's true. Which of the following items will be the same for a flexible budget and a master budget? That is our fixed costs. Which of the following is true of a flexible budget? It calculates total variable cost by multiplying actual units by budgeted variable cost per unit. That is true. Let's look at the rest. It calculates total fixed cost by multiplying it. No, that's not true. Calculates revenues by multiplying budgeted units by actual selling price per unit. No, it's not the actual selling price, it's the budgeted selling price. And D, it calculates the contribution margin by multiplying budgeted units by contribution margin per unit. No, it actually, you calculate the contribution margin by subtracting the revenues minus the variable cost. So A is the correct answer there. Number 23, effective planning of variable overhead costs means that managers must increase the expenditures, not necessarily. It may be possible. Focus on activities that add value to the customer. No, that's a different thing. Increase the linearity. No, and identify product advertising requirements and factor those into the variable overhead budget. Actually, I think it's going to be C. Increase the linearity. Yeah. And then 24, this is standard costing. Which of the best defines standard costing? Is this the same as actual costing but done in real time? No, it is a system that traces direct cost to output by multiplying actual processor rates by actual quantities of inputs. Back up here. No, a system that traces direct cost output produced by multiplying standard price or rates by standard quantities inputs allow for that. That is true. So C is the correct answer on 24. 25, which is the following is the correct mathematical expression to calculate fixed overhead spending variance. So the spending variance is the actual minus the flexible budget amount. So that's that one. Fixed overhead costs. Have no efficiency variance. Remember, the efficiency variance is between the flexible budget based on inputs and the flexible budget based on outputs, or the middle column versus the right-hand column on our normal. And then fixed overhead costs include, that would be leasing of machinery. That would be true. So it could be energy costs, but leasing of machinery is usually fixed. 28. In flexible budgets, the costs that are not flexed because they remain the same within a relevant range of activity are called fixed costs. 29. The variable overhead flexible budget variance can further be explained by calculating the price variance and efficiency variance. No, it's actually the spending variance and the efficiency variance there. And when they talk about the flexible budget variance, that is the variance between the actual and the flexible budget amount. Number 30, when variable overhead efficiency variance is favorable, it can be safely assumed that variable overhead efficiency variance, assume that the actual quantity of cost allocation basis used is higher than, no, is going to be lower than. So D is the correct one there. All right, now we get into some problems. Lubriderm Corporation has the following budgeted unit sales for the next 6-month period. We see there June, July, August. There were 30,000 units on hand. The beginning of June, plans are to have inventory of finished products equal 20% of next month's sales. 5 pounds of materials are required for each unit produced. So each cost of material costs 8 pounds. So A, we are going to use July, August, September, October, and November. Remember, we are looking for June, July, July, August, and September. So we're looking for those. Okay. Roll that down a little. There we go. So in July, we sell 120,000. In August, we sell 210,000. September, we sell 150,000. October, we sell 180,000. And November, 120,000. Okay, so that's our sales. And then we need our ending inventory. And we are told that it will be 20% of next month's sales, so that'll be 42,000 there, be 30,000 here, will be 36,000 here, and 24,000 here. We add those up and we get our total needs. We then subtract our beginning inventory. Okay, so they gave us the number for 30,000 units for June, but we need July. So that's going to be 20% of that, or 24,000. 20% of the 120,000. And so this will be our production. Okay. And then now we can just slide these down. So 42,000, 30,000, and 36,000. Um, 198,000 there, 156,000 here, 188,000 here. Okay, so that is the answer to A. And then B asks us to prepare the purchases budget. So so each one is required. 5 pounds of materials are required for each. So here, 5 pounds of materials are required for each unit produced. Each pound of material costs $8, and we want 30% next month's need. So we're going to use these 138, 198, 156, and 188, like so. We are going to multiply those by the 5 pounds. That'll be 690 pounds. That'll be 990 pounds. 780 pounds. And 940 pounds. So that's now our quantities needed to produce this many units in pounds. We've got to add our ending inventory. Same process as what we have above, right? So, except it's 30%, so I need 30% of 990 is 297, and 780 is 234, and finally 940 is 282, and that one drops off. Add those up. 987 1,224,000 1,062,000 pounds. Now we have to subtract off the beginning inventory. We're not told the beginning inventory, so now we need to calculate it. It will be 690 times 30% is 207. And so we need 787 pounds. Now we can slide those down just like we did before. $927 there and $234. And 828,000 there. So this is our answer in pounds. And now we simply multiply the cost by $8. $6,296,000. $7,416,000 and $6 million. All right, and so that is our answer for part B. So these are the dollars. Guess I'll label that, and then these are the pounds. There. Okay. All right, number 32. Duffy Corporation has All right, Duffy Corporation has prepared the following sales budget. Collections are 40% the month of sale, 45% the month following sale, 10% 2 months following. And so we want July through September. So we've got July, August, and September over there. It's 2 months following sale. So we go May, June, July, August, and September. All right, now in this one, obviously your cash sales are, you can do that however you wish. I would just be fine if you just put it right there at the top line. The sales are 18,000 in cash in July, 24,000 cash in August, and 22,000, right? Cash sales are collected at the time of sale, so you don't have to worry about splitting those up over collection period. All right, then in May, we're going to collect 2 months or 10%. That's 2 months later. July is 2 months later. And so 10% would be 1,600, and we're done with May. June, we've got, oops. I did the cash sales there. That was bad. The credit sales are 80,000, so that would be 8,000. Yeah, that's not good. Okay, now we've got 74,000 in credit sales. And we are told we're going to collect 45%. It's going to be 33,300. I'm getting this all confused here. We're still in, yeah. Let me print that page out and start over again. There it is. That's page 5. All right, so we've got cash collections here, and we want July, August, and September. All right, we're going to have cash sales. Then we've got May credit, June credit, July credit, August credit, and September credit. Okay, so our cash sales July is 18,000. August is 24,000. And September is 22,000. All right. Now, May is 2 months prior to July. So we've got credit sales of 68,000. So that should be 6,800 because it's 10%. Okay. And we are done with May. Now we go down to June and it is 80,000. And we will collect 45% in the month following sale. So that will be 36,000. And 10% in August, which will be 8,000. Okay. Then in July, we have 74,000 in credit sales. And so that will be 29,600. We have 74,000 times 45. That will be 33,300. And then 74,000 times 10% is 7,400 in September. All right, then we get to August. We're not going to collect any of August in July. We will, however, we will sell 92,000, and we will collect 40% of that. And so that's 36,800 of August sales that will be collected in August, and 92,000. Is 41,400, 45% of the 92,000. And then finally, in September, nothing there, nothing there. We've got 76,000. And we're going to collect 40% of that is 30,400. Now, we just add those up. 18,000 plus 6,800 plus 36,000 is 90,400 will be collected in July. $102,100 in August. And 101,200 in July. Okay. The third one, number 33. The president of the company, Peter Francis, has come for help. Use the following data to prepare a flexible budget for possible sales production levels of 10,000, 15,000, and 20,000 units. So we've got 10,000 level, 15,000 level, and 20,000 level. So this is going to be a flexible budget before the fact, right? Since we're doing multiple things. And so we start with our revenues. And our revenues are $30 per unit times 10,000. Should be 300,000, but let's check it. And it is. 15,000 will be 450,000, and 20,000 will be 600,000. So that takes care of our revenues. Then we have the variable costs, and we're going to split this up: manufacturing, admin. I don't know what administrative costs are variable. Selling, obviously, things like commissions. Those are so $10 per unit times 10,000 units is $100,000. Administrative $3 per unit times is $30,000. And then selling is $1 a unit times 10,000 units. And that's going to lead us to our contribution margin, which is 300,000 minus 140,000 is 160,000. Now we just do the same thing here. This will be 150,000. This will be 45,000. And this will be 15,000. 60 is 210. So our contribution margin is 240,000. Finally, for the 20,000 unit level, we will have 200,000. Then we will have 60,000 for the variable administrative costs and 20,000 for the variable selling costs. Gives us contribution margin of $320,000. Okay. All right, then we add our fixed costs. And we've got manufacturing and admin, 70,000 and 30,000. That's 100,000. So our operating income will be 60,000 here. Remember, fixed costs stay fixed. So we've got 70,000 and 30,000. Again, 100,000. So that gives us 140,000 there. And here we've got the same 70,000 and 30,000 for 100,000 gives us 220,000 operating income. So that kind of shows you the power of volume with fixed costs. Finally, the last one on this set, we have the SkyTalk Company manufacturer weather vanes. The 2020 operating budget is based on the production of 5,300 weather vanes with 1.25 machine hours allowed per weather vane. Variable manufacturing overhead is anticipated to be $145,000. Actual production in 2020 was 5,250 weather vanes. Using 6,050 machine hours. Actual variable costs were $21.75 per machine hour. And so we're asking us to do the standard costing for variable overhead. So we've got the actual here. We've got the the flex on inputs and the flex on outputs on those. And so our actual is going to be 6,050 times 2175. Is going to be 131,580 87. Now, we used the 6050. Those are the actual hours used, but now we're going to use now we've got to figure that out on that. So that's going to be 145,750 divided by 5,300. This is the budget times 1.25. And so we are allocated 6,625 hours. And we had 145,750. And that would be $22 per machine hour. So that's our standard, is $22 per machine hour. And we get 133,100. And we get 1,513, and that is favorable. Okay, the flexible budget based on outputs is going to be 5,250 weather vanes times 1.25 hours per weather vane times 22. And that's going to be 144,375. And so our efficiency variance will be 11,275. Said it right, wrote it wrong. And that will be favorable. All right, so that is round one. I'll be back with another one of these here in a bit.